Today, we're unpacking a company right at the cutting edge of global intelligence. One that promises to help its customers act not just fast, but first. But, as its stock has recently soared, the burning question we're tackling is, has the market maybe gotten ahead of the fundamentals for BlackSky Technology? Welcome to the Deep Dive. This is where we take your sources, pull out the most important nuggets of knowledge, and help you get truly well-informed, fast. We've got a really fascinating deep dive for you today, focusing on BlackSky Technology, Inc. That's ticker symbol BKSY, trading on the New York Stock Exchange. Our sources for this are comprehensive research reports, company filings, all current as of July 7, 2025. And the stock closed then at $21.48 per share.
That's right. And this company, it's really a prime example of the high-stakes, high-reward world of the commercial space industry. So our mission today is to help you understand what BlackSky actually does, how it makes money, who it's up against, and maybe most crucially, what its financial health and, the market perception really tell us about its future.
We'll navigate this deep dive in two main parts. First up, we'll explore the company's core business. We'll look at management and the financials. Then in the second part, we'll shift focus to market sentiment, the ownership structure, key risks, and finally, our concluding outlook. And hey, as we go, if you're finding this valuable, please remember to like and subscribe to the Stock Analytics AI YouTube channel. We're actually covering all of the S&P 500 stocks over the next few months, and members paying €4.99 a month get exclusive priority access to these deep dives. Want a one-off on a specific ticker? Just drop us a super chat. Thanks, we appreciate the support. Okay, let's begin our explanation with Chapter 1, Business Analysis. So, to kick things off, what exactly is BlackSky selling here, and what's their unique edge, their secret sauce in this pretty competitive landscape?
Well, BlackSky operates on what's called a vertically integrated business model, and that means they're quite unique in that they design, they own, and they operate their own constellation of these high-performance low Earth orbit, or LEO, small satellites.
Yeah.
But it isn't just about launching hardware, right? This space infrastructure is really the backbone supporting their main business, which is software as a service, SaaS, and data as a service offerings.
Right, so it's a whole ecosystem they control. How does that translate into, actual revenue streams? How do they make money?
They have two main streams. The first and the biggest one is imagery and software analytical services. This is their core subscription business. It provides on-demand satellite imagery, access to their AI-driven monitoring platform. It includes both recurring fees and usage-based consumption.
Okay.
The second stream is professional and engineering services. This involves more customized, sort of project-based work. Think developing specific software features for certain clients, or even designing satellite systems for government needs.
That distinction you made between just pictures and intelligence, that seems really crucial. So how exactly does BlackSky's Spectra AI platform turn that raw satellite data into actionable insights? And what does that first-to-know advantage really mean for their customers on the ground?
Yeah, the Spectra AI platform is definitely the centerpiece. It's an advanced analytics engine. It ingests just massive amounts of data, both from their own satellites and also third-party sensors. Then it applies their proprietary AI and machine learning to detect changes, monitor activity, generate insights. And this whole process, that's what gives customers that first-to-know advantage. How? By delivering on-demand imagery in under 90 minutes.
Under 90 minutes. Wow.
Yeah, providing high-frequency monitoring up to 15 revisits per day over strategic locations, and using AI-driven analytics to automatically spot anomalies and alert customers. It's really about proactive intelligence, not just reactive data.
That is a powerful capability. So where does BlackSky primarily operate within this market? Who are their main customers really benefiting from this kind of speed?
They've definitely carved out a strong niche with very demanding clients, primarily within the U.S. government's defense and intelligence communities. We're talking about agencies like the National Reconnaissance Office, the NRO, the National Geospatial Intelligence Agency, NGA, and the U.S. Space Force.
Right.
Their services are, well, mission critical for these types of entities.
Okay, but here's something our sources really highlighted. BlackSky's significant customer concentration. Their 2024 10K filing shows 3 major customers accounted for a staggering 88% of their revenue. 88%.
Yeah.
That's a notable risk factor, wouldn't you say? especially given they had, what, 12 operational satellites back in late 2022 and are pushing this big expansion with their Gen 3
Oh,
program?
absolutely. It's certainly a concentration risk, a big one. And while they are actively pursuing international and commercial clients trying to diversify, their current revenue base is just firmly anchored in the U.S. defense sector.
Right.
So this makes contract wins and, crucially, renewals with these key agencies absolutely vital for their financial stability and, their growth path.
Okay, moving on then. Let's turn to Chapter 1, Industry Analysis. Given BlackSky's unique offering, it's worth understanding the broader currents driving this whole market. What are the big trends shaping the geospatial intelligence industry right now?
Well, BlackSky operates right at the intersection of several really high-growth markets. The broader geospatial analytics market, which includes everything from mapping to advanced intelligence, it's projected to grow from roughly $114 billion in 2024 to over $226 billion by 2030.
Wow.
That's an 11.3% compound annual growth rate as CAGR.
Healthy?
Very. And even more specific subsectors like commercial satellite imaging, they're growing at a strong 9.7% CAGR. And satellite data services, which is really BlackSky's primary focus, that's accelerating even faster at 16.3% CAGR.
Okay, so strong tailwinds. But what's fueling this kind of expansion? What are the underlying drivers pushing these numbers up?
There are several powerful drivers at play. First, the deep integration of AI and big data. It's creating entirely new kinds of insights from geospatial information that just weren't possible before.
Makes sense.
Then there's increasing government and defense demand, often spurred by, escalating geopolitical instability around the world. That's a significant factor.
Right.
We're also seeing growing commercial adoption across really diverse industries. Think agriculture, logistics, infrastructure management. They're all finding uses for this data. And finally, there's just the essential need for satellite data in critical areas like climate and environmental monitoring.
The competitive landscape is always crucial.
Yeah.
Who are BlackSky's main rivals in this rapidly expanding, but you said fragmented, market?
Yeah, it's fiercely contested. Key rivals include Planet Labs.
Yeah.
They have that massive constellation focused on broad area daily change detection across the globe. Then there's Spire Global, which specializes in other types of data, like weather patterns and maritime tracking. Different focus. And you can't forget Maxar Technologies. They're a long-standing incumbent, known for very high-resolution imagery and, crucially, deep government ties.
Okay.
There are also more specialized players like ICYE and Capella Space. They focus on SAR, that's synthetic aperture radar imagery. It provides capabilities that actually complement BlackSky's electro-optical data, especially, in bad weather or at night.
Interesting. So how does BlackSky stack up against these rivals on some key financial metrics? What insights can we maybe draw from those comparisons?
Well, if we compare them, BlackSky has a market cap around $680 million. That's smaller than Planet Labs at $2.07 billion, but larger than Spire Global at $370 million.
Okay.
But what's truly insightful here, I think, is BlackSky's exceptionally high gross margin. It's nearing 69.4% to 73.1%.
That's very high.
It really is. And it isn't just a healthy number. It suggests their core service, once delivered, is incredibly profitable on a per-unit basis. It implies that if they can achieve sufficient scale, they have significant operating leverage.
The potential is there.
Exactly. Now, their 2024 revenue growth at 7.05% year over year, that does lag behind Planet Labs, although their specific YoY wasn't provided in our sources. It's generally seen as faster. And Spire actually had negative growth. But BlackSky's superior gross margin, that indicates a very strong value proposition for their specialized intelligence offerings.
Given the enormous capital requirements you mentioned for this industry, what about the regulatory environment and barriers to entry? Is it easy for new players to just jump in and compete with BlackSky?
Oh, absolutely not. Not at all. This industry has formidable barriers to entry. People often describe it as having a deep moat.
Okay.
Regulations by agencies like NOAA include things like resolution limits for commercial satellites, really strict licensing, export controls on sensitive tech. And these aren't just one-time hurdles. They represent ongoing costs and risks.
Right.
But the most significant barrier, honestly, is the astronomical capital investment required. A single satellite launch can cost anywhere from $50 million to $400 million.
Wow.
Plus, you need extensive ground infrastructure. Then you have the technological hurdles, finding the right talent, that regulatory gauntlet we just discussed, and the incredibly long time to market. It just takes years to get a constellation operational and actually generating revenue.
So it's not just about having the best tech, but also having the deepest pockets and frankly the longest patience to even get started. That really puts the scale of investment needed here into perspective. So what does all this mean for BlackSky's competitive advantage? What's their unique moat, according to our sources?
Well, Warren Buffett famously looks for businesses with a durable competitive advantage, right? For BlackSky, it seems to be a combination of factors. First, they've built pretty strong brand strength and recognition within their core market. They've established themselves as a trusted provider for those critical U.S. government agencies. That reputation is invaluable.
And what about their strategy for cost advantages? Is there anything there?
Yeah, a key strategic move here, building a potential long-term cost advantage, is their vertical integration. Remember, in November 2024, they acquired the remaining 50% of LeoStella LLC, their satellite manufacturing partner.
Right, the acquisition.
Exactly. This gives them direct control over the design, production, and importantly, the cost of their crucial next-gen Gen 3 satellites. It could potentially accelerate innovation and significantly reduce production costs compared to relying on third-party manufacturers. Then you also have network effects and switching costs. For their government customers, BlackSky's services are often deeply integrated into mission-critical workflows. That creates substantial switching costs. Just disentangling their systems would be complex and expensive for those agencies. Plus, the Spectra AI platform itself has the potential for a data network effect. As more data gets fed in, its AI and machine learning models get smarter, more accurate, more robust.
They get harder to replicate.
Exactly, harder and harder for rivals to replicate that capability.
So it's the sum of these parts then. The integration of their assets, that's what really defines their edge.
Precisely. Their most distinct advantage seems to be that integrated system of their high revisit satellite constellation combined with their proprietary Spectra AI platform. This unique focus on automated, AI-driven insights from high-cadence imagery in near real-time, that's their key differentiator, and the planned Gen 3 satellites with that enhanced 35-centimeter resolution and the shortwave infrared imaging, they're specifically designed to widen this technological lead and potentially unlock new capabilities in customer segments.
Okay, let's shift our focus now to Chapter 2, Management Evaluation. How does a leadership team stack up, especially given the company's pretty ambitious growth plans we've been discussing?
Well, BlackSky is led by CEO Brian O'Toole. He's described in the sources as a serial entrepreneur with over 30 years of experience in geospatial intelligence. His track record includes founding a geospatial intelligence startup that was later acquired by BlackSky, and he also guided a successful $1.3 billion merger for a company called GeoEye.
Okay, so experience is there.
Yeah, it suggests a leader who deeply understands both the highly technical aspects of the industry and the complex business dynamics. The broader management team is also considered experienced, with an average tenure of about 3.5 years, which indicates some level of stability at the top.
What about transparency and ethics? How does the company conduct itself as a publicly traded entity? Any red flags?
They seem to maintain standard public company communication. There's a dedicated investor relations portal. Comprehensive SEC filings are readily available. Our sources did note a recent amended Form 4 filing, which corrected a prior error. You could argue that suggests a culture that prioritizes transparency and compliance. And importantly, no red flags regarding their ethical reputation were found in the provided sources.
Okay, good. Next, let's consider Chapter 2, Capital Allocation. We've established the need for significant investment in this industry. How exactly is BlackSky's management using its capital? What does that tell us about their priorities?
Management's capital allocation seems laser-focused on one thing: reinvestment for growth. They're pouring significant and actually increasing investment into R&D, particularly for those next-gen Gen 3 satellites and continuously enhancing the Spectra AI platform.
Right.
And that acquisition of LeoStella, their satellite manufacturing partner, that was a highly strategic move, right? To fully control their supply chain, double down on their core business, and accelerate the deployment of that crucial Gen 3 constellation. Now, as for shareholder returns, things like share buybacks or dividends, this is crucial for investors to understand. BlackSky does not pay a dividend and has no history of share buybacks.
Right.
Every dollar is being reinvested into expansion and technological advancement, which, is the textbook strategy for a company in this capital-intensive high-growth phase.
So don't expect checks in the mail.
Exactly. Don't expect capital returns in those traditional forms anytime soon.
And what does their return on invested capital, or ROIC, currently tell us about how efficiently they're actually deploying all that capital?
Well, their ROIC is currently deeply negative. The sources show it ranging from -18% to -27%.
Oof.
Yeah, But for a pre-profitability company that's investing so heavily in long-term assets, this isn't entirely surprising. It really reflects the massive bet management is making. They're essentially sacrificing any short-term returns to invest heavily in their foundational assets. The satellites, the AI platform, which they clearly believe will generate very high returns way out in the future.
Right.
So the entire investment thesis for BlackSky, therefore, it really hinges completely on those projected future returns materializing.
Okay, now that we have a handle on their operations and management strategy, let's dive into Chapter 3, financial analysis. What does their current financial snapshot look like, and how has that revenue been growing?
Well, BlackSky really has the classic profile of a high-growth tech company. You see impressive top-line expansion, but it's coupled with significant bottom-line losses. Its market capitalization is approximately $680 million, which puts it firmly in the small-cap category, and that, as you know, can mean higher growth potential, but also inherently higher volatility and risk.
Got it. And the revenue growth itself.
Stellar, actually. Over the last 5 years, they've achieved a compound annual growth rate, CAGR, of 49.41%.
Wow, nearly 50% compounded.
Yeah. In fiscal year 2024, revenue grew a solid 8.0% to reach $102.1 million. And looking forward, analyst consensus actually expects revenue growth to reaccelerate to over 21% annually.
Okay.
So this strong top-line growth is undoubtedly a key part of the bull case for the stock.
That top-line growth sounds promising, definitely. But what about profitability? With all that investment we talked about, how does that picture look?
Yeah, the profitability story is a stark contrast. While their gross margin is very healthy, hovering in that 69% to 73% range.
Which we noted earlier, yeah.
Yeah, right, suggesting their core services are indeed profitable on a per-unit basis. But their operating margin is around minus 42%, and their net profit margin is about minus 50%.
Right.
This significant split, this bifurcation, it's central to their financial profile. That high gross margin implies a lucrative underlying business model if, and it's a big if they can achieve sufficient scale to overcome those massive fixed costs associated with R&D, sales, admin expenses, etc.
And free cash flow, often called the true lifeblood of a business. What does that tell us about their financial needs day to day?
Well, free cash flow has been consistently and significantly negative. For fiscal year 2024, it was minus $56.7 million.
Burning cash.
Burning a lot of cash. And this substantial cash burn is a key risk factor, obviously. It highlights their ongoing need to access capital markets, whether that's through debt or equity, to fund both their operations and their ambitious growth plans.
Okay, moving to Chapter 3, financial stability. What about their debt load, especially given that cash burn?
Their debt-to-equity ratio stands at 1.26. That means they're financed more by debt than by equity.
Okay.
Now, for a pre-profitable company that's burning cash, this is a significant risk. Interest payments can strain liquidity, and refinancing becomes critical down the line. Their primary debt actually matures in October 2026, so that's an important date for investors to keep an eye on.
Definitely.
But on the flip side, their short-term liquidity, as indicated by their current ratio of 3.79, is very strong.
Okay, that's good.
Yeah, it means they have $3.79 in current assets for every $1 of short-term liabilities. That provides a healthy cushion for immediate obligations. And, as we mentioned before, no dividend payment, which, again, is totally expected for a company in this growth phase.
Right. Finally, for this part, Chapter 3, valuation analysis. How do we even begin to value a company like BlackSky that isn't profitable yet and is in such a capital-intensive growth phase? Traditional metrics seem tricky.
You're right, they are. Traditional metrics like the price to earnings or PE ratio, they just aren't meaningful here because BlackSky has negative earnings, as do its direct public competitors, by the way.
Right.
So a more appropriate metric for growth companies that aren't yet profitable is often the price to sales or PS ratio. This compares the market cap to the revenue. BlackSky's PS is around 6.0 to 6.6, which puts it at a premium to Spire Global. They're around 3.9x, but still at a discount to Planet Labs, who are around 8.5x.
Okay, so kind of in the middle of its peers there.
Kind of in the middle, yeah. Now, since earnings are negative, to try and estimate an intrinsic value, we typically have to use a discounted cash flow model, a DCF. The idea here, as you know, is to sum up all the future cash the business is expected to generate and then discount that back to today's dollars. But for a cash-burning company like BlackSky, this model is highly speculative. It relies heavily on forecasting a clear path to profitability and substantial future cash flows. But it's still valuable for understanding the key drivers that would make it a successful investment.
So, acknowledging the speculative nature, what did our educational DCF model suggest? based on the source data.
Okay, so based on a set of highly sensitive yet plausible assumptions, our educational DCF model estimates the intrinsic value of BlackSky to be somewhere in the range of $16 to $24 per share.
$16 to $24.
Yeah.
It's important, though, to understand just how dependent that range is on those assumptions you mentioned. Can you elaborate a bit on what those entail?
Absolutely. I mean, this range really depends on some aggressive but arguably plausible assumptions. This includes really high revenue growth, starting around 30% and then gradually declining over 10 years, which is supported by those strong industry tailwinds we discussed earlier.
Right.
Crucially, it also assumes a pretty dramatic path to profitability, with operating margins eventually reaching levels you might see in mature software companies. That's a big leap.
Yeah.
And significantly, we have to use a high discount rate, somewhere between 12% and 15%, to properly account for the substantial risks inherent in a pre-profitability volatile company that also has a leveraged balance sheet.
Okay, that context is vital. Now let's turn our attention to the market in the future with Chapter 4, Market Sentiment. What's Wall Street saying about BlackSky, and how is the broader market reacting to its story, especially given that recent stock surge?
Well, the analyst community, according to our sources, is overwhelmingly bullish on BlackSky. They have a consensus strong buy rating from 100% of the covering analysts.
100%, that's strong. Yet what's interesting here is the tension you see in their price targets. The average 12-month price target seems to range from about $15.42 to $19, which notably is below the current share price we mentioned, $21.48.
Yeah.
What does this discrepancy suggest? How do analysts view the stock's recent run versus its longer-term potential?
Yeah, it's a really interesting point. It suggests that while analysts clearly believe in the company's long-term prospects, the underlying technology, they likely see the stock's recent, very rapid appreciation as having potentially stretched the valuation beyond what their near-term models can justify.
The market got ahead of the models.
Perhaps, yeah. The target range itself, going from $14 all the way up to $26, that's also quite wide. It indicates a lack of strong consensus on the precise current valuation. Now, the general media tone around BlackSky has been largely positive. It's been driven by significant contract wins, like that recent $24 million contract from the NGA you mentioned,
Right.
and also progress on their next-generation satellites. The stock itself has been a major news story, surging an incredible 90% in just the last month.
90%.
Yeah, often linked to increasing geopolitical tensions, which obviously fuel demand for surveillance services. However, you do see some cautious reports out there that consistently highlight the company's continued lack of GAAP profitability, kind of keeping a check on maybe unrestrained enthusiasm.
Okay, what about Chapter 4, Market Indicators? What are the smart money signals? What about broader trend signals telling us about investor conviction or lack thereof in BlackSky?
Well, despite the generally bullish news and that incredible momentum, there's a significant contingent betting against the stock. Short interest is high. It's reported at 12.8% to 13.1% of the public float.
That is high.
It is. And it indicates a strong bearish sentiment from a meaningful portion of the market that believes the stock's price is going to decline from here. Conversely, though, the stock is trading substantially above both its 50-day simple moving average, that's around $11.31 to $12.31, and its 200-day simple moving average, $10 to $11.66.
Okay.
So this confirms powerful upward momentum and signals a strong long-term uptrend for the stock itself. It suggests that, for now at least, the bullish forces are clearly winning the tug of war.
Interesting dichotomy there. Let's now explore Chapter 5, Ownership Structure. Who actually owns BlackSky, and what does that tell us about investor confidence and maybe control?
Okay, so institutional investors, think mutual funds, hedge funds, they own a significant portion. The sources give a range from 27% up to 55% of outstanding shares, so a big chunk. Over 200 institutions are on the shareholder registry, including really prominent names like BlackRock and the Vanguard Group. And what's positive here, I think, is that in the most recent quarter, more institutions actually increase their positions than decrease them. That indicates a net positive flow of institutional capital into the stock recently.
Okay, that's a bullish sign. What about insiders, the management team, the directors? High insider ownership usually signals confidence, right? But are there any nuances we should consider here?
Yeah, insiders do hold a substantial stake. It's estimated from 4.5% up to maybe 22.6%, depending on the source.
Okay.
And generally, yes, a high level of insider ownership is seen as positive. It aligns management's interests with shareholders. However, here's an important nuance from the filings. Most of the recent acquisitions by insiders are actually non-market transactions. This is where directors receive shares as part of their compensation, often at zero cost.
Ah, okay. not buying with their own money.
Exactly. They're not open market purchases with their own cash. And while this is standard practice, it doesn't send the same strong bullish signal as if they were actively buying shares on the open market at current prices.
Right.
There have also been some dispositions, likely related to exercising stock options. So the key takeaway, perhaps, is the notable absence of significant discretionary open market buying from top insiders. You could interpret that as a neutral signal regarding their view of the stock's current valuation. Ownership is also relatively concentrated. One analysis suggested the top 7 shareholders collectively control a majority 52% stake, which just means a small group of large investors can potentially significantly influence the company's direction and strategy.
Okay, we've covered a lot of ground. And with any investment, understanding the potential pitfalls, the risks, is absolutely crucial. So let's move into Chapter 6, Risk Assessment, and break down BlackSky's profile using a classic SWOT analysis. What are BlackSky's core strengths based on our sources?
Okay, BlackSky's core strength seem to be its internal technology-driven advantages. First, that vertically integrated model, significantly strengthened by the LeoStella acquisition we discussed. Second, its proprietary Spectra AI platform combined with that high revisit satellite constellation that offers unique real-time insights. Third, those strong, established relationships with critical U.S. government agencies, that provides a solid base. And fourth, an experienced management team guiding the strategy.
So those are the internal advantages, but what about the weaknesses? Where are the vulnerabilities in their business model or their financials?
Well, the most significant weaknesses are definitely financial. A history of substantial net losses and consistently negative free cash flow. That's number one.
Right, the cash burn.
Exactly. This is compounded by that high customer concentration we keep mentioning, 88% of revenue from just 3 customers. That's a huge reliance. And then there's that notable debt-to-equity ratio of 1.26, which is certainly a risk for a cash-burning company. And finally, it's just a highly capital-intensive business model. It requires continuous large-scale investment just to maintain and expand operations.
Okay. Despite those weaknesses, there are compelling opportunities, right? What does the future potentially hold?
Absolutely. BlackSky is really perfectly positioned within a massive and rapidly expanding market for geospatial intelligence, fueled by those powerful secular trends we talked about. Rising geopolitical tensions, somewhat paradoxically, directly increase demand for its services, creating an unexpected, albeit unfortunate, tailwind.
Right.
There's also significant potential for them to diversify by expanding into international government markets and also commercial markets, getting beyond their current U.S. defense focus. And crucially, those next-generation Gen 3 satellites are expected to unlock entirely new capabilities and revenue streams, further differentiating them from competitors.
But then there are the external threats. It sounds like a lot of what drives their demand, geopolitics, is also a source of significant risk.
You're absolutely right. It's a classic double-edged sword. The company faces formidable external threats. Competition is intense, and it's constantly evolving, coming from larger, well-funded rivals with potentially deeper pockets. Its heavy reliance on government spending makes it vulnerable to budget cuts or just shifts in political priorities. Some reports cited potential NRO spending reductions on commercial imagery, which would directly impact BlackSky if that happened. And in this rapidly innovating sector, the threat of technological obsolescence is always present. A rival could develop a superior, cheaper solution tomorrow. What's also critical here is the impact of broader macroeconomic factors. Persistent inflation, for example, can increase the costs of manufacturing satellites, components, labor, prolonging their path to profitability. And high interest rates are particularly potent for a company like BlackSky. They increase the cost of capital for this already capital-intensive business. And from a valuation perspective, they directly lower the calculated present value of a growth stock like BlackSky, whose value is tied way out in future earnings because those future earnings get discounted back at a higher rate.
Makes sense. And those geopolitical factors, which you called a double-edged sword, how do those play out specifically as threats?
Yeah, they absolutely are.
Wow.
While rising global tensions drive demand, they also create a really complex operating environment. The rise of state-backed competitors, particularly from countries like China, represents a significant long-term threat to market share and technological leadership.
Okay.
And you can imagine hypothetical scenarios like broad U.S.-imposed tariffs that could potentially disrupt BlackSky's intricate global supply chain, increasing manufacturing costs for satellites or impacting their margins. Lots of external factors.
Okay, we have reached Chapter 7, Conclusion. Let's try and synthesize everything we've discussed into the core bull and bear cases for BlackSky. What are the strongest arguments for investing in this company? What's the bull case?
Okay, the bull case for BlackSky seems to rest on four strong pillars. First, it operates in a massive, high-growth geospatial intelligence market with those powerful tailwinds behind it. Second, it appears to have a genuinely differentiated technological advantage through its vertically integrated model, combining that high revisit satellite constellation with its proprietary Spectra AI platform. That combo is unique.
Uh-huh.
Third, it has strong government backing with large, multi-year mission-critical contracts, providing a solid, predictable revenue base, at least for now. And finally, there's a clear path to significant future growth with the planned deployment of its next-generation Gen 3 satellites, assuming they execute well.
Okay, that's the bull case. But the bear case sounds equally potent, focusing squarely on risk and valuation, but in quite a different picture.
Precisely. First and foremost, there is no profitability. That's the headline for the bears. The company is burning significant cash, has a history of net losses, and isn't expected by analysts to be profitable in the near term. That makes it, by definition, a speculative investment.
Right.
Second, it carries a high-risk profile. It's capital-intensive, heavily customer-concentrated, faces intense competition, and is highly sensitive to those macroeconomic factors we just discussed. Third, the valuation appears stretched, especially after that recent run-up. You have an elevated price-to-sales ratio and significant short interest, suggesting the market has already baked in a lot of future success. And finally, the entire investment thesis really hinges on flawless execution. They have to nail the Gen 3 rollout, and management has to prove they can scale revenue much, much faster than costs. That's a significant operational challenge.
Okay, and just to recap our valuation exercise, traditional metrics like PE aren't applicable here. Based on our educational discounted cash flow, or DCF model, which, again, relies on those aggressive growth and profitability assumptions we discussed, we estimated an intrinsic value range of $16 to $24 per share.
Yeah, and this raises an important question for you, the listener, really.
Yeah.
What stands out to you from this deep dive? Which factors do you weigh most heavily when you're considering a company like BlackSky? Is it the tech,
The risk.
the valuation?
And that brings us right to our concluding outlook. As of July 7, 2025, BlackSky's share price of $21.48 falls squarely within the upper end of that educational intrinsic value range we calculated, $16.24. So this suggests that, at its current price, the market seems to have already priced in a significant amount of future success and pretty optimistic growth. While the company's technology, its market position, and its growth prospects are certainly compelling, the current valuation appears to leave a somewhat limited margin of safety for investors if the company faces any setbacks in its ambitious and very capital-intensive growth plans. It looks like a high-risk, high-reward proposition where the market's bullish sentiment is currently running quite a bit ahead of the company's fundamental financial performance. So what does this all mean for you? Well, BlackSky is definitely a fascinating company, riding some powerful trends. But like any investment right at the cutting edge, it comes with its own unique set of complexities and risks that hopefully you now have a deeper understanding of. Certainly something to mull over as you consider the future of geospatial intelligence and maybe your own portfolio.
If you found this deep dive valuable, please remember again to like and subscribe to the Stock Analytics AI YouTube channel. Members paying $4.99 months get priority deep dives on tickers. We're covering all of the S&P 500 stocks over the next few months, and members get exclusive priority access. And if you just want a one-off deep dive on a stock you're interested in, just drop us a super thanks. We really appreciate it.
And as always, a crucial reminder, this analysis was generated by an AI system purely for educational purposes only. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Thank you for joining us for this deep dive.